Part 2. Fintech companies are innovating a wide range of financial products and services, which includes crowdfunding, mobile and online payments, P2P lending, microfinance, and cryptocurrencies. First is crowdfunding. Crowdfunding platforms allow internet users to send or receive money from others on the same platform. Moreover, it allows individuals or business to pool funding from ordinary people without having to meet with a bank loan officer anymore. Those who want to transact through these online platforms need little more than a computer or smartphone with internet connection. Two types of crowdfunding are rewards-based crowdfunding and equity crowdfunding. Let's begin with reward-based crowdfunding. Reward-based crowdfunding allows donors like you to contribute capital for project of your choice, and upon the successful of the project, you receive your rewards. For example, if the project is a video game, you might receive a free copy of the video game. The most popular reward-based crowdfunding site are Kickstarter and Indiegogo. Equity crowdfunding is quite similar to reward-based crowdfunding, but with one major difference. When you invest in equity crowdfunding, you receive an actual ownership stocks in a new project you invest. If the new project earns huge profit, you are going to receive your share of profit. As one example, when Facebook was first launched to public, the first investors earned massive earnings. Equity crowdfunding operators such as Alex Global, Atta Plus, and Crowdonomic provide alternative funding platforms for small and medium enterprises and startups. Second is mobile or online payment. The most used forms of fintech in the country are digital payments and mobile wallets. Through fintech, it is possible to exchange and manage funds, trade stocks, pay for food, or manage insurance only by using your smartphone. Some of the well-known mobile payment apps and digital wallet service in the country are GrabPay, Touch and Go, and Boost. Let's see this video to learn more about e-wallet.
Hi, what's going on? Thanks for tuning in. If you're new here, my name is Ash. And today, let's talk about e-wallet in Malaysia. I'll go over the basic understanding of an e-wallet and what is available in the current Malaysian market. Also, a quick demo on how to use it. Let's jump into it.
What is an e-wallet? E-wallet is a digital or electronic wallet you use in your smartphone. Similar to your current physical wallet, you can store your money, in this case e-money, credit, debit, prepaid card details using a technology called tokenization. There are a few features which entice users to use it, namely bill payment, parking payment, transfer credit to your friends, and many more. Some e-wallets even offer discounts and cashback to reward users. How does it work? User to download, register, activate and top up the e-wallet. Merchant to share the amount payable. User to scan the merchant's QR code and key in the details and PIN code. Done. How many types of e-wallet are there? In general, there are two basic types of e-wallet. Stage wallet, pass-through wallet. A stage wallet is where you put money into the wallet and spend that money. A pass-through wallet, on the other hand, is like a receptacle which holds your cards and gives you a direct link to your source of funds. Each e-wallet type has its advantages and disadvantages. Most e-wallets we see today are stage wallets. Pros and cons of e-wallet. No more bulky wallets. You get to carry less cash and cards. Skip queue or visit to ATM or bank. Faster transaction and convenient. Less concern on cash loss due to robbery or pickpocket. No risk of carrying counterfeit money. Excellent budget tracking method as every spending is recorded. Plenty of rewards, offers, cashback and discounts available. Transaction might fail due to poor internet connectivity or service provider issue. There is always risk of digital fraud. Confusion caused by too many e-wallets in the current market. The list of e-wallets. It will be time-consuming to mention the names of all e-wallets in Malaysia. To date, Bank Negara Malaysia, our central bank, has issued 44 e-money issuers licenses. If you're interested, I'll put the link from BNM's website in the description below. The major ones are Boost, GrabPay, FavePay, BigPay, Touch and Go e-wallet, and WeChat Pay. I won't be covering the details of each e-wallet. You can find it from the link in the description below. Hopefully that will help you to decide on which one you want to use. I have also made a video a couple of weeks ago on Touch and Go RFID, which utilizes the Touch and Go e-wallet. You may check that out from the title card above and in the description below. Let's move on to the quick demo. Quick demo. I'll be using GrabPay for this demo on top of other e-wallets that I'm using. Firstly, launch the Grab mobile app. Okay, my GrabPay balance might not be sufficient to pay for our tea. Let me quickly top it up. I'll choose cards and wallets as I have saved it from previous top up. Choose the top up value, 100 ringgit, and hit confirm. That's done pretty fast. Now tap on pay and scan the static QR code. Key in the amount, which is 52 ringgit and 10 cents, and hit done. Notice that I can also use up my points to reduce the total payment. Not gonna use that now. Tap on pay and it's paid. That was fast and convenient. You can view the transaction detail to ensure it is accurate. It will also be reflected on the physical receipt.
Third, peer-to-peer or P2P lending is another growing area in fintech. Peer-to-peer or crowd lending is where online platforms help to match borrowers with lenders and bypassing the banks. Goldman Sachs and US-based Lending Club has made a name for itself in the P2P space as the world's largest online credit marketplace, facilitating personal and business loans. In particular, equity crowdfunding and P2P lending platforms are usually lumped together, but they are not the same thing. Equity crowdfunding allows investors to buy shares in a new project. Investment document like shareholder agreement will govern the rights of the new shareholder. While P2P lending or crowd lending is when a borrower borrows money from the lenders on the same digital lending platform. The financing terms are set out in an investment note, which includes the interest rate, repayment terms, and so on. This video provides you examples for both crowdfunding and crowd lending.
Crowdlending or crowdfunding, which is better for a small business? It depends on the status and nature of your business. Crowdfunding is typically better for businesses in which a concept needs to be proven. Crowdlending is better for businesses with a proven business concept that are looking for growth. Why? Crowdlending is a loan, not a gift. You borrow money and pay back principal and interest to investors. Let's take Jenny as an example. Jenny wanted to start a coffee shop and provide real Italian espresso to people in her neighborhood. She put down 3 months' rent and bought a second-hand espresso machine. She did this by giving away free t-shirts, cookies, and coffee, a classic crowdfunding approach. Jenny's coffee shop has been very, very successful. She wants to expand and buy a second espresso machine. This time, rather than crowdfunding, she is using crowd lending. She's reaching out to her customers and neighbors, offering a loan with interest, which she'll pay back monthly over time. Jenny was successful in her crowd lending campaign. She bought the second coffee machine. Her lines have shrunk. Her customers are happy. It's been a win-win for everyone.
Fourth is microfinance or microcredit. Fintech has moved underway to provide microfinance to low-income individuals or group of people that typically excluded from traditional banking. Most microfinance or fintechs focus on offering credit in the form of small working capital loans for small-scale businesses, sometimes called microloan or microcredit. The loan can be used for housing and education too. Many microfinance fintechs also provide saving accounts and insurance for their clients. But whether or not microfinance benefits the poor people to escape the poverty is yet to be proven. So, who pioneered the concept of microcredit in the world? Let's find the answer in this video.
Poverty is a kind of a darkness around you. You don't see any hope, any ray of hope. You live every day the same way in the darkness. You don't have a future.
In the early 70s, a young Muhammad Yunus, then an economics professor, left the city to do research in local villages like this one.
Here I am teaching elegant theories of economics in the classroom, and people are dying outside the classroom, and we have nothing to do about it.
He found people making many beautiful products, yet they remained desperately poor. To an economist, it didn't make sense. Something was missing.
But if you look around, who are the people really working? It's the poor. They work their pants off.
Professor Yunus realized that the only way the villagers could buy supplies to create small businesses was with high-interest loans from unscrupulous moneylenders. There was no other option.
And moneylenders were imposing very terrible conditionalities on them, like you have to sell your product to me at the price that I decide, etc., that kind of thing.
In one village, Muhammad Yunus found that he could provide life-changing loans to 42 people. They would cost a total of $27, an average of 64 cents each. He personally made the loans.
And I was shocked. Here we talk about millions of dollars and billions of dollars of development assistance to help the economy grow and so on. We never paid any attention to people who needed such a small amount of money.
That was the beginning of an idea that grew into the Grameen Bank, a bank for the rural poor. In the language of Bangladesh, Grameen means rural. It's also the idea for which Muhammad Yunus and the Grameen Bank were awarded the Nobel Peace Prize in 2006.
Poverty is
And finally, cryptocurrency. Cryptocurrency is a digital or virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend. Unlike paper money, it typically does not exist in physical form and is not issued by a central authority. The most popular cryptocurrency in the world is Bitcoin. Transmission of Bitcoin is verified by other users and recorded on the public ledger, known as blockchain. The blockchain technology is also being used to settle transactions, keep track of money flows in real time, and reduce fraud. Cryptocurrency and blockchain are hallmark examples of fintech, but with some controversial issues storming investment world in recent years. Next video will explain more about the impact of blockchain and Bitcoin, especially in accounting practice.
Have you heard of blockchain before? Blockchain technology is on the rise, and it will have major implications on the future of accounting. So what exactly is a blockchain? A blockchain is a decentralized, chronological ledger protected by cryptography. The ledger is made up of a chain of blocks, which each contain information about transactions. For example, if you wanted to use a blockchain to track the ownership of a house, each block would contain information like the buyer, the seller, and the sale amount. Blockchains are like the general ledgers that accountants use every day. They're non-destructive, so when a block needs to be changed, the original is left intact, and a new entry is made at the bottom of the ledger. That way, everyone can see when and why the change was made. Most people hear blockchain and think Bitcoin. But blockchain isn't limited to just cryptocurrency. You can trade, record, and track almost anything with blockchain, including deeds, medical records, and financial transactions. Blockchains are peer-to-peer and decentralized, which means there's no centralized bank or other trusted institution controlling transactions. Instead, individuals agree to verify and control transactions using their own computers and the software code that powers blockchain. Every personal computer is a single node in a vast, interconnected network, and every node has its own copy of the blockchain ledger that automatically updates when a new block is added. This decentralization means the blockchain is very secure. In a centralized system, such as a bank, hackers only have to attack one institution to gain access to the data they want. To attack a blockchain, hackers would have to attack every single node in the network. The security of blockchains makes them an ideal tool to use in accounting. Because they're so secure and resistant to modification, blockchains can be used to securely process payments, record transactions, and execute documents. As a result, blockchain technology may replace certain aspects of an accountant's job, such as bookkeeping, verifying transactions, maintaining and reconciling ledgers, and auditing. Blockchain will probably have the biggest impact on auditing. Blockchains are real-time, update faster than any human, and do it all with fewer errors. In some cases, auditors may not be needed to verify ledgers. With the power of blockchain, the day-to-day tasks of an auditor must be completely reimagined. However, this automation of routine tasks won't make auditors a thing of the past. Instead, auditors will have more time and resources for higher level thinking, research, and strategy. Instead of working on mundane tasks like record keeping or verifying ledgers, auditors will dive deep into data and provide valuable takeaways to their clients. Accountants will need to be interpreters between complex blockchain processes and clients. While every accountant won't need to know the nitty-gritty of how blockchain technology works, they'll need to be able to draw meaningful conclusions, give sound advice, and demystify blockchain for clients. Change is ahead, bringing fear and uncertainty for many. But blockchain technology doesn't mean the end for accountants. Instead, it's an opportunity for accountants to reshape their roles, evolve their skills, and embrace a new technology that will help them supercharge their results.